The Stanlib Multi Manager Flexible Property Fund recently won a Raging Bull Award for the best risk-adjusted returns over 5 years. The fund combines the approach of a balanced fund in that it limits its exposure to listed property and can use fixed interest instruments to control risk. Malcolm Holmes from Stanlib Multi Manager joins us in studio to tell us a little bit more about the fund.
Malcolm, I think we just wanted to kick off and just get a correct definition of what this flexible property fund actually does and the way it operates. So maybe you can just tell us, how you can allocate capital within the portfolio.
Sure. Well, thank you very much for having me on the show. This is a flexible property fund. So we have between 40 and 85% in listed property at all times, and the remaining assets, be it 15 or 60, depending on wherever the underlying managers feel that they should be, that is invested in fixed interest stocks. So it could be cash, or it could be ILBs, bonds, preference shares, up to 10%. So it's a flexible property mandate that really is trying to garner as much income from the income generating asset classes as possible.
Now, in terms of, and this is the way that I understand balanced funds work, is that they have the equity component which they use for their risk on trade, if you want to call it that, and then they use fixed interest to sort of make sure that they've got nice, strong cash flows in the portfolio at the same time. Is it the same way you kind of approach the flexible fund? So if I asked you what your allocation is to listed property at this point, that would be a good barometer of the type of risk that you're taking or happy to take in the market at this point.
Absolutely. I mean, balanced funds are typically akin to equities as the core. Here we've actually got properties as the core asset, and that can vary between, as I said, 40 and 85. We at the moment are sitting at 70% in property.
So a high allocation to the listed property space.
It is. Property's done very well over time, and I think the underlying managers that we've selected have obviously picked up on that theme. Internally, we have a 65% property, 35% income benchmark. So that's the benchmark that we give the managers, and they need to try and outperform that. So this is a hell of a unique product. There are very few products like this in South Africa. In fact, there are very few managers that manage mandates like this in South Africa, and we obviously very proud of how it's done. If you think about it, a risk-adjusted return is exactly the type of award that this fund was kind of almost geared to achieve, whereas other fully invested property funds do just sort of rise and fall with the market, so to speak, plus or minus the alpha that the managers can generate.
In terms of the listed property, you're a multi-manager as well. What does that mean in terms of how you select the constituents of the underlying basket you run?
Sure. I think there are about 5 or 6 institutional flexible or managers that can manage a flexible property mandate. So our goal is to really try and pick the best ones that we can find, and then we leave the stock selection up to them. So we don't worry about whether it's Growth Point or Redefine. We obviously monitor them on a regular basis. We check performance against our hurdles, against their hurdles, and we check this. We've got good knowledge of the shares that they're invested in, but ultimately the key trick to this portfolio is being in property when the property market's going up. So on average, we're at 70 at the moment, but on average, I reckon we've been at about 75 to 80 through the last 5 years. And we've been as low as about 60% at times when the market is looking dodgy. So if our managers can get that call right, they do very well for this portfolio, because it takes the risk off when the markets are falling, and it puts it back on when the markets are rising.
Malcolm, when it comes to the selection of the managers of the portfolio, do you see a lot of churn? You talk about the benchmarks in place and you check against those benchmarks, or do you generally find that you are backing the right guys?
We've been lucky. We started this portfolio with Coronation. A guy called Edwin Schultz down at Coronation managed absolute return mandates, and he was also their property specialist. And we didn't have enough money in those days from an assets under management perspective to actually employ 2 managers, so we started with one, and that was Edwin down in Cape Town, and that relationship has lasted us 9 years. It's been
a cornerstone of the portfolio.
It's been a cornerstone of the portfolio. They manage about 50% of the portfolio right now, and about 6 years ago, when Marriott Warner joined Stanlib, together with Marriott and Henk, they were a very credible combination in the property fixed interest space. That's Henk Viljoen. And that was a very credible alternative as well. So we put them in about 6 years ago, 5-6 years ago, and they too have done exceptionally well. So most of the credit for this, the performance and the award, really does go to them. because they've done an exceptional job for us. They've navigated the tough fixed interest environment very well.
Malcolm, just in terms of some of the underlying managers, I understand Keelan and Lofu, one of the Stanlib managers who's got quite an envious record himself, would be one of the constituents in this fund as well.
That's
so
right.
You would be delegating him to run the listed property equity side for you.
Absolutely. So Keelan, who runs the listed property franchise at Stanlib Asset Management, effectively has been asked to do two things. He's been asked to make an asset allocation decision over 65 or under 65 in property as an example, and then to select the best stocks inside of property that he can find. He will most likely outsource the fixed interest allocation to Henk Viljoen inside of that fixed interest team. So the skills that we look for in a flexible property manager are tactical asset allocation skills or asset allocation skills, as well as the manager's ability to select great property stocks. And I think both Coronation and Stanlib Am in the property space have proved themselves. I think they're probably 1 and 2 respectively in that space. And in the fixed interest space, both of them are highly rated by our research team at Stanlib Multi Manager.
With that allocation of around 70% to the listed property space, there's got to be a macro underpin that you believe that listed property is going to outperform down the line or continue the good performance that we've seen to this point.
Absolutely. And luckily, we outsource that to the underlying managers. However, I can say that property's done 25% per annum for the last 10 years, and that's a phenomenal.
And many people have missed the boat.
And a lot of people have missed the boat, and it's quite interesting now because a lot of institutional investors are actually getting involved into property in quite a big way, making them almost permanent allocations in their risk profile portfolios. And all of that activity results in a more sort of demand for shares than supply for shares, so prices typically go up. And these property companies have done very well. They've grown their income streams or earnings by 25% during that period of time. So our outlook for property is really whether you think it's expensive at the moment or not from a yield perspective. And if you look back at 2007, it's almost exactly the same pricing and valuations as it is today. We just think that the circumstances surrounding property were better in 2005, 6 and 7 in terms of vacancies, economic growth than it is today. And as a result of that, we would actually encourage investors to be in a flexible property fund like this rather than a fully invested property fund.
It's been somewhat of the performance has been quite phenomenal. Even just buying a passive strategy in property, listed property, has yielded fantastic returns. Even last year, I think, in the region of 30%. But we've seen a mini listings boom in the property space. We've seen a lot of listed property companies coming to market, as well as that, when combined with the very low interest rates, is there not a little bit of a risk of a bubble in the listed property space at this point?
I wouldn't say a bubble, but interestingly, 10 years ago there were 24 listed companies. Today there are only 28 listed companies. So the reality is that most of these companies have actually grown by acquisition. The market cap has gone from 14 billion to 200 billion of the property sector in that 10-year time frame.
Just do those numbers again.
14 billion was the market cap.
To 200 billion.
To 200 billion. During that period of time, the weighting in the all share for property, as an example, has gone from 1% to about 3.5% in the all share. So property has certainly benefited from a lot of the goodwill that's out there. Certainly interest rates coming down do benefit. We are cautious on property, there's no doubt, but I don't think it's a bubble, because I think you can have there is sort of prospect for income growth of around about 4-5% from these companies, and if you add on the income yield these companies generate of about 5-6%, you can easily get to a sort of a forecastable 10% return. The difficulty is, however, the derating or re-rating of property. From this point, we think it's quite expensive, so we would say it would derate. So for us, anywhere between 5 and 10% would be an acceptable return after 10 years of 25%.
Malcolm, just to talk about I think you're probably the best position to talk about the relative yields between listed property and fixed income. Just run us through the sort of way you think about it and what you're seeing from, as you say, getting a yield that can grow perhaps at least in real terms in the listed property side versus what you're getting in fixed income at the moment.
Sure. Bonds don't grow their income. Property grows their income. That's the attraction of the asset class from the rental incomes that they earn and the escalations in the contracts. So listed property is probably on a forward yield of about 6%. On the South African 10-year bond, you can probably get about 7%. Inflation linkers maybe slightly more. Unfortunately, cash is only going to give you about 5 or 5.5%. So that's the array of yields that you can get out of the market. So our managers are trying to navigate through that, the income yield spread to try and find those assets that are going to grow nicely from a capital growth perspective, and then B, produce high yield.
So just to talk about, and without going into too much detail, because as you say, you don't pick stocks, but you obviously get a good sense of what's happening in the South African property space. What are you seeing at this point? Because we know that it seems the office market is still recovering. It's still very much in recovery mode. It's bottomed out, but it's improving. Perhaps industrials pretty strong, and retail always seems to kind of chug along. What's the sort of breakdown in the three sectors there?
Well, I think retail is by far the preferred sector right now. I think maybe followed by industrial and then office. There is a fair amount of vacancy in the office space in certain nodes, but the retail sector has been buoyed by general consumerism globally as a whole. So most of the companies that our managers are investing in have a broad spread of all of them, and that adds to the diversification benefits of this portfolio as a whole. There must be 1,000 buildings in the portfolio. So it's a very interesting portfolio.
Malcolm, thanks so much for your time. Congrats on the Raging Bull.